For years, silver has sat in an uncomfortable place in the global economy, too industrial to be treated like gold, too small to be taken seriously like oil, and too misunderstood to be priced for what it actually does. But something has changed, not suddenly, not loudly. The change has been slow, technical, and buried inside supply chains, trade flows, and institutional behavior. And now that change is reaching a point where it can no longer stay hidden. A new shock is forming in the silver market, and it's not coming from speculation, hype, or retail investors. It's coming from reality. The first sign of this shock is not price, it's behavior. When markets are healthy, silver moves freely. It's sold, delivered, recycled, and replaced without friction. But when stress enters the system, behavior changes. Buyers become cautious, sellers hesitate, contracts get longer, inventories are guarded instead of circulated. And over the past year, that shift in behavior has become impossible to ignore. Industrial users are locking in supply earlier, banks are tightening access, refiners are facing longer lead times, and physical silver is quietly becoming harder to source at scale. This matters because silver is not a discretionary material. It is not a nice to have, it is essential. Solar panels cannot function without it. Electric vehicles cannot operate efficiently without it. Medical equipment relies on it. Communications infrastructure depends on it. Advanced electronics require it. Once silver enters these systems, most of it does not return to the market. It is consumed, embedded, and effectively removed from circulation. That makes silver fundamentally different from commodities that can be reused easily or replaced quickly. For a long time, the global system relied on the assumption that silver supply would always be there when needed. Mines would produce enough. Recycling would fill gaps. Inventories would smooth out fluctuations. That assumption is now under pressure. Mine output has stagnated. Ore grades have declined. New projects face long timelines, political risk, and rising costs. Recycling helps, but not nearly enough to offset growing demand from technology and energy sectors. The result is a tightening market that no longer has a margin for error. What makes this moment especially dangerous is that the silver market is layered. There is the physical market, the metal that actually exists. And then there is the paper market, contracts, futures, ETFs, and financial claims that represent silver but are not silver themselves. For decades, the paper market dominated price discovery. As long as physical supply was sufficient, this system worked. But when physical availability tightens, paper pricing loses authority. The market stops listening to charts and starts responding to scarcity. This is where the new shock begins to form. As physical demand rises and inventories fall, the gap between what is promised on paper and what exists in reality grows wider. Most of the time, this gap stays invisible, but when enough stress builds, it becomes impossible to ignore. Deliveries are delayed, premiums rise quietly, large buyers negotiate privately instead of using open markets, and suddenly price starts reacting faster than expected, not because of excitement, but because of constraint. Another factor accelerating this shock is the changing role of silver in global strategy. Silver is no longer viewed only as a commodity input. It is increasingly treated as a strategic material. Countries expanding renewable energy, modernizing military systems, building data infrastructure, and securing communications networks all rely on silver. When materials become strategic, they are no longer traded casually. They are secured, stockpiled, and protected. This shift removes silver from open circulation, it tightens availability further, and it creates competition between industries, institutions, and governments, competition that did not exist at this scale before. At the same time, the financial environment is becoming less forgiving. Inflation has altered cost structures, energy prices remain volatile, interest rates have reshaped investment decisions, global debt levels limit policy flexibility. In this environment, supply shocks are no longer absorbed easily, they ripple outward, and silver sits at the intersection of multiple vulnerable systems: energy, technology, finance, and geopolitics. This is why the shock forming in the silver market is not isolated. It is connected to broader stress across the global economy. When silver supply tightens, production costs rise. When production costs rise, technology becomes more expensive. When technology becomes more expensive, growth assumptions are challenged. This creates feedback loops that amplify the initial problem. The early stages of this process often look confusing. Prices may move erratically. Pullbacks appear even as shortages worsen. Commentators argue about manipulation, speculation, or sentiment. But underneath the noise, the physical market tells a different story, and that story is becoming clearer each month. One of the most important signals is how large players are behaving. Institutions with deep access to data are not selling silver aggressively, they are holding it. Industrial buyers are not relying on spot purchases. They are planning years ahead. Banks are becoming more cautious about availability. These are not reactions to headlines. They are responses to conditions, and conditions are tightening. This brings us to the question everyone eventually asks: what comes next? The next phase is not a sudden collapse or a dramatic overnight spike. It is a repricing process, a slow recognition that silver's role in the modern economy is larger than previously acknowledged. That recognition forces adjustments. Long-term contracts reset at higher levels. New projects are evaluated under different cost assumptions. Financial products face scrutiny over physical backing, and price behavior changes. In this phase, volatility increases. Silver stops behaving like a forgotten metal and starts behaving like a constrained resource. Pullbacks become shorter, rallies become sharper. Price ceilings that once held begin to fail. Not because of hype, but because the market cannot reconcile growing demand with limited supply. The most important thing to understand is that this shock is not driven by emotion. It is driven by math. Inputs versus outputs. Consumption versus production. Availability versus promises. When those numbers stop aligning, markets adjust, whether participants are ready or not. And unlike past cycles, this one does not have an easy release valve. Supply cannot be expanded quickly. Substitutes are limited. Recycling has physical limits. Demand is embedded in systems that society has already committed to building. That is why this shock is different. It is not about fear. It is not about speculation. It is about necessity. As silver becomes harder to source, those who need it most will pay whatever is required. That dynamic changes how the market functions. It shifts power away from traders and toward users, away from short-term pricing and toward long-term access. Eventually, this process becomes visible to everyone, not because someone announces it, but because the effects become impossible to ignore. Prices move faster, supply news matters more than sentiment, and silver stops being treated as an afterthought. By the time that happens, the shock will no longer be forming. It will be underway. The warning signs are already here. The behavior has already changed. The system is already under pressure. What comes next is not chaos. It is adjustment. A difficult, uneven adjustment to a reality the market avoided pricing for years. And once that adjustment begins in earnest, silver will not return to the role it played in the past. It will be seen for what it has quietly become: one of the most important materials in the modern world, entering a period where availability matters more than perception. That is the shock forming in the silver market. And what comes next is not a surprise. It is the consequence of ignoring it for too long.